We're now going to look at Chapter 9, Saving, Investment, and the Financial System. So we're leaving the area of growth economics and switching now to look at the financial system. Why we have it, what it does, and what happens when things go wrong with the financial system. So the core ideas we'll look at are the supply of loanable funds, the demand for loanable funds, equilibrium in the market for loanable funds. And when we study loanable funds, we'll be using the basic demand and supply type of model. Then we'll look at the role of intermediaries. The financial sector has a lot of different instruments and a lot of different sorts of organizations. So the question is, why are they there? Why do they exist? What do they do? We'll then move on to look at what happens when intermediation fails. So when there's some kind of breakdown in the banking system, for example, why does that happen and how does it affect the economy? Then we'll look at an actual historical episode which helps to make the theoretical ideas concrete. And we'll be looking at the financial crisis of 2007 to 2008, or sometimes people say 2007 to 2009. And that will allow us to discuss leverage, securitization, and shadow banking. And then we'll have some takeaway conclusions. In the theory of growth material that we looked at in a previous chapter, we talked about savings. We talked about savings within the Solow model, but we did not explain or describe how the level of savings gets determined. We just assumed that households were saving a certain proportion of their income. Now in this chapter, we're going to get into the fundamentals of saving and investment. And we're going to talk about specific instruments and specific types of organization that are involved in bringing about saving. And what you'll see is that the level of savings in a society is to a large degree a choice. It's the cumulative choice of many different individuals and families and other organizations' choice what to do. So, in order to accumulate capital, and by here I mean capital as in machines, it's necessary to save some of your production. You cannot be devoting all of your production to producing consumption goods. So savings are necessary for capital accumulation. And the more capital an economy can create, actually I should say how much it can create, not how much it can invest, the greater will be GDP per capita. For this all to work, you have to have two sides. You have to have a saving side and a borrowing side. There's no point your household being willing to save unless there's something to do with the money. There has to be somebody who wants to borrow the money. So connecting savers and borrowers is what the financial system is fundamentally about. And connecting savers and borrowers increases gains from trade and smooths economic growth. And the analogy we're using is a bridge. On the left-hand side of the bridge there are the savers, and the savers could be households, they could be firms, they could be venture capitalists. And on the right side are the borrowers. Those are the people or organizations that want to borrow in order to create capital. And that includes firms, of course, but also individual entrepreneurs and households too. If a household, a family wants to increase the size of their house, that's a form of investment. So households can be on both sides of the bridge. Now, how do you get from the left-hand side to the right-hand side? Well, you need some kind of intermediary, an intermediary institution of some sort, or intermediary organization to help match up savers and borrowers. So sort of a matchmaking function. And in the middle there, you see the matchmakers are the banks, bond markets, and stock markets. And we'll be talking about how all these work together over the next couple of slides. When talking about the financial sector, we need to be clear about the meaning of words. Now, the word saving simply means income that is not spent on consumption goods. The word investment can have at least two different meanings. It can mean the purchase of new capital goods, such as a factory buying machines. Or investment can mean financial investment. We use the word investment to mean putting money in the bank, for example, or buying stock in a company. We call that investment. So it's important to understand the word investment has different meanings depending on the context, and you have to look at where it's being used to figure out which interpretation is intended. So if we are going to formulate some kind of theory about saving and borrowing, we need some kind of model of how the world is. And one of those models is called the life cycle theory of savings. And the life cycle theory of savings says that the desire to save is not random. There's a kind of logic to it and a kind of predictable pattern to it. And in the life cycle theory of savings, we imagine a person who starts out young. They don't have very much, and they're going to travel through their entire life cycle. And what we figure is that, let's say, a young adult who's just joined the workforce is likely to be a borrower. Perhaps they want to borrow to buy a house. They want to borrow to buy a car because they don't have a car, that kind of thing. And the life cycle theory of savings says, on average, in some kind of general sense, younger people in the workforce tend to be borrowers. Then those people move to their best sort of earning years, doing whatever it is they're doing to earn income. And that's the time when they're liable to be savers. So they've already bought their house, they've bought their car, those sort of things. And so now they're earning more than they're spending. And so they're net spenders during the middle phase of their life. And then comes the time perhaps when they retire. And when they retire, they're not earning any more income. So there's obviously no saving. And this is the time when they're dis-saving. They're doing the opposite of saving. Now they are drawing down their accumulated lifetime savings, so that in retirement, they can continue to enjoy life. So this sort of pattern is following for an individual their life cycle. And what that means is, in the first stage, the borrowing stage, this hypothetical person is on the one side of the bridge, the borrowing side of the bridge. When they're in the savings period, they are now on the opposite side of the bridge. They're the lenders, they're the savers and the lenders. And then when they go back in the last stage, they're dissaving, they're no longer on the saving end of the bridge. Now, the fundamental logic for a person doing this is we assume that the regular person prefers to keep their standard of living tolerably equal during their life. Now, maybe not exactly equal, not perfectly equal like in the diagram, but certainly a normal person would not want their consumption to exactly match their income at each point in life, because that means when they're young, they're living off ramen and crackers and drinking water, okay? And when they're in their work years, they're living really well, but after retirement, it's going to be terrible. They're going to be living off dog food. All right, we assume the normal person prefers to keep a tolerably even consumption path, as we say, represented by the blue line. Again, we don't mean literally it's going to be exactly the same, but we do sort of imagine a rational person will want to somewhat smooth out their situation over their life cycle. So this slide basically summarizes what I said when showing you the previous slide, the life cycle diagram, and it adds one more thing, that saving is not just about perfectly managing your consumption over your life. Saving also builds a cushion for unemployment or unexpected health problems or unexpected other problems. So saving has what is sometimes called a precautionary motive. Precautionary as a form of insurance, not simply a calculated set aside to generate a certain definite payoff in the future. So now we're going to do a model of borrowing and lending. And the good news, in a way, is that this model is fundamentally using demand and supply, the demand and supply model that we've done before. So keep that in mind and don't be put off by the fact that we're going to be using these finance type terms. Under the surface, this is simply a demand and supply model, except we're applying it to something that's not oil or some kind of physical good. So in the financial market, what's being bought and sold are dollars, and we'll actually give those dollars a certain classification for this situation, and that is to call those dollars that are being traded back and forth loanable funds. It's sort of like the total supply in the economy of savings that is out there available for somebody to borrow if they want to borrow. But if they're going to borrow, they're going to have to pay a price, and the price is interest, the interest rate. So if you want to, quote, buy my loanable funds from me, you have to recompense me with interest on top of the principal that you're borrowing from me. So let's get terms clear. The dollars being bought and sold are called loanable funds. In this model, the analogy to the buyer in demand and supply is borrowing. The seller of loanable funds is the person who's lending. Got that? We have two sides, a buying side and a selling side. The buying side are the borrowers, the selling side is the lenders, and the interest rate is the price that adjusts up and down in order to bring the quantity demanded and quantity supplied of loanable funds into equilibrium. It's just like demand and supply. You need some kind of price to adjust to bring about equality between what people want to buy and what other people want to sell. So in the oil price model we did before, the price of a barrel of oil is what adjusted up and down. In this model, it's the interest rate, and the interest rate is a general economy-wide interest rate we're talking about. So to build our model based on demand and supply, we will start with the supply side first, because that's more intuitive. The supply side are the people who have saved and are the potential lenders. Now, what induces a lender to lend is the interest rate they expect to get. And there's an upward sloping supply of savings line. So for example, take an individual case. Suppose you wanted to borrow $200 from me. I'm going to require some interest rate to do that. And let's suppose the interest rate I require is 5%. That's the amount of, in a sense, profit I'll make by allowing you to borrow $200 from me. If you want to borrow more than $200, let's say $280, you'll have to offer me a higher interest rate, say 10%, excuse me. And so you have an upward sloping supply line, and that's true for the economy as a whole. All the savers will have an upward sloping line, and if you aggregate them into one big line, that represents the supply of savings for the economy as a whole. When we talk about the economy-wide demand and supply for loanable funds, we're aggregating the effects of different individuals. And individuals are different in their preferences. So for example, the more impatient a person is, the more likely that that person's savings rate will be low. So when it comes to comparing costs and benefits, everyone is not identical. Everyone has different sort of degrees of patience. We have a term for that. It's called time preference, the desire to have goods and services sooner rather than later, all else being equal. So if there's no inducement to lend, people will not lend, because there is this built-in time preference. That's why you have to reward people for lending. Now we're going to take a slight detour from building a demand and supply model to introduce a little bit of behavioral economics here. If we are talking about the phenomenon of borrowing and lending and making decisions that relate to the future, we can show that people, although generally rational, are not hyper-rational, they're not super-rational, they're not perfectly rational. An example is, suppose a company offers employees a retirement savings plan. The company will deduct money from their paycheck, put it into some kind of account, earning some interest, and then when the employee retires, they can get back the money that was saved. It turns out that if the employer offers option A is, here's the employer's default rate of deduction, but the employee can step in and change the rate of deduction to whatever the employee wants. Got that? There's a default, there's a starting rate, and if the employee wants to do something different, they can. They just have to go in and do the paperwork to change it. And the second option is no default. The employer says, just give me a number. I'm not suggesting any number, there's no default. Just write down the number of amount of deduction you want to do. Now, in theory, if employees are hyper-rational, being given a default, non-binding starting default rate should not give a different answer than if the employee starts out with a blank sheet and writes down a number. But it has been shown and confirmed beyond any doubt that if an employee is offered a default rate of deduction, they will have a bias to just saying yes to the default plan and going with that. But if they are offered or given only the option to write down the rate they want off the bat, they systematically do a lower rate of deduction. So let's be clear. Effectively, the two options are the same. The employee gets to choose the rate of deduction. The default rate, though, means you're starting with a sort of suggested rate in your head, and you have to undo that if you want to get a different rate. And systematically, when people are given a default rate, they go with that and therefore end up saving more on average for the future. So this is an example where psychology plays an important role. You cannot explain this result by a pure rational, super rational, calculating kind of brain. And behavioral economics gets into the reasons why this happens. And part of the reason this example works, I should say, is because you're dealing with the future. You're making a decision not whether to have chocolate ice cream now or vanilla ice cream now. You're making a choice about future ice cream. And anything to do with making choices that have consequences in the future, you get different results and strange results. And that's all we'll do for behavioral economics here. But I just thought I should introduce that concept if you've not heard of it before, because this is the kind of choice problem where behavioral economics really can help us kind of comprehend what people will actually do, not necessarily what strictly rational economic theory will say. So here we're looking at the demand side, and the demand side is the behavior of the borrowers, and there's no surprise that if the prevailing market interest rate to borrow is very high, quantity of borrowing demanded, that is to say, the degree to which borrowers are willing to borrow, will be less if they have to pay a higher interest rate. You have to pay a high interest rate, you don't want to borrow much. And that's why it's downward sloping and to the right. The interest rate is like the price you pay to borrow. So we get the downward sloping demand to borrow line. And what that also means is if you begin with an interest rate in the market generally of 5%, in this diagram you get $300 billion of demand to borrow. But if you have a 10% prevailing market interest rate, the demand for borrowing is only $190. So, as you know from the demand and supply model, you have a demand side line, you have a supply side line, and if you put those two things together, you get the demand line and the supply line, and you get an equilibrium value for the interest rate and an equilibrium value for the quantity of buying and lending loanable funds. And just like in demand and supply, you can have a market price that is so high that you get an excess supply, and in this case it's an excess supply of savings. So if in the market to borrow the interest rate is 10%, there'll be lots of people willing to lend to you, to supply lending, I should say. And if you lower the 10% to the 8% level, then you get equilibrium. And if you have an interest rate that is particularly low, like 6%, you've got a lot of people wanting to borrow, but only a few people willing to supply savings, and now you have a shortage. So the analogy is just like what happens in the market for regular competitive marketing goods. You have an equilibrium interest rate, an equilibrium quantity of borrowing and lending, and we think that you will get there because if you're at an interest rate that's too high, the pressure will be downwards on the interest rate. And if you have an interest rate is too low, in the sense that there's excess demand to borrow, the pressure on the interest rate will be upwards. And the only spot, the only place where you don't have kind of forces trying to push you away from that point is at the equilibrium, which in this diagram is 8% for the interest rate and 250 billion. And just like in the regular demand and supply model, if you shift the supply curve, or you shift the demand curve, or you shift both curves, you will change the point of equilibrium. And if you change the point of equilibrium, you're changing the equilibrium interest rate, and you are also changing the quantity of savings and borrowing. So it's a shock to demand and supply and equilibrium that causes the interest rate to move around. So if you start at an equilibrium point and people become more thrifty, that is, the savers are willing to save more, that shows up as a shift to the right in the savings supply line. That line moves to the right. And that's an example where something has affected the minds of the people who save, and that's reflected in that rightward shift of the red line there. And that means you'll get a new equilibrium. At the new equilibrium, there'll be a lower interest rate, and there'll be more saving and borrowing. Now, the behavior of the borrowers can also change. And we show changes in the behavior of the borrowers by changing the position of the demand curve. So the demand curve could move, for example, to the left if for some reason the desire to borrow has fallen. Now notice, the desire to borrow here, or demand to borrow, is talking about a movement of the entire line. So the entire line is moving. If the entire line is moving, it is not because the interest rate has changed. It's because for some reason borrowers have less appetite to borrow. And if you shift that demand to borrow line to the left, what you're going to do is change the equilibrium. And since borrowers are less keen to borrow, what's going to happen is that the market interest rate is going to fall, as you can see by the intersection point there. you've moved from $250 in saving at an 8% interest rate to a $200 level of saving and borrowing at a 6% interest rate. So that's what happens if, for some reason in the market, everything else equal, there's less demand to borrow. So there are multiple types of financial intermediaries. Financial intermediaries are the different sorts of organizations that facilitate all this kind of borrowing and lending we were talking about. And these organizations specialize in facilitating borrowing and lending. And banks, bond markets, and stock markets serve borrowing and lending for different sorts of purposes. So borrowing and lending is a very general form of trade. It's trade over time, and trade over time occurs for different reasons. And that's why we have the different sorts of financial institutions. So savers want to move their capital. Now here, capital, when we say capital in the context of savers, what we mean is their loanable funds. We're not talking about machines. Savers move their capital to find the highest returns. That's a general tendency. And borrowers include people like entrepreneurs who have to find the right investments and the right loans. The market for borrowing and lending is not a simple market. It's a complicated market of different sorts of organizations wanting to borrow and lend for different sorts of reasons. And the saving side is also different. You may have an institution with millions of dollars or billions of dollars to lend. Obviously, that's not going to be a good match for an individual who wants to borrow money to buy a new car. So we have a whole sort of ecology of different institutions to deal with all the different sorts of trade over time that goes on in finance. So we'll run through some of the institutions, and one kind of institution, the one we're most familiar with in finance, is banks. And here we're talking about like your local bank or credit union. Credit unions are basically the same as banks with some small differences. So banks receive savings from many individuals, and it pays those individuals interest. Banks agglomerate all those small funds into big packages and lend those funds to borrowers and charge them interest. And banks earn their profit by charging more for the loans than they pay to the savers. So there's this profit margin by that interest rate difference. And they also earn the money by evaluating investments and spreading risk. And the intuition there is that the individual regular person doesn't have time to go around checking out all the million different ways to invest their money. So they're contracting that job out to the bank by putting their money in the bank and allowing the bank to take a sort of profit margin. And the other thing is spreading the risk. If an individual person were to make an individual loan to, let's say, a small local business, that's pretty high risk. But when a bank takes money from depositors, it makes loans to many different sorts of business and other ways too, and therefore the bank is not betting the farm on any one particular investment working out. And the bank can do that because it's got a lot of money. It can spread the money into all kinds of different ventures. Whereas we as individuals, at best, a regular individual might only be able to make a loan to one or two small businesses, and that's pretty high risk. this arrangement is efficient for society. And it's a form of specialization. It's a manifestation of the idea that we're better off when we specialize in doing single things well, instead of trying to do many things badly. And banks specialize in loan evaluations. They're better able to decide which business ideas make sense, and that's partly because they're able to invest in getting the data and the expertise to make good judgments. And it would be incredibly wasteful if every saver spent time evaluating the same businesses. So banks are doing a sort of coordination function here, and they're spreading default risk across many lenders. They're not betting the farm on any one lender. And there's another thing that does not relate to the borrowing and lending function, which is sort of new, and that's the final line there. Banks also play a role in the payment system. Banks are fundamental to the simple monetary functions of the economy. They're supporting the use of what we call the medium of exchange to buy and sell. And we'll come back to that medium of exchange role later. Excuse me. Now, here's another definition: collateral. Collateral is something of value that by agreement becomes the property of the lender if the borrower defaults. So collateral is something that allows a lender to have more confidence that if a loan goes bad, they have a sort of insurance policy. They're going to be able to take possession of something called collateral. Now, collateral is the second resort. It's not what the lender wants to end up with, but it's at least some form of guarantee that they won't lose everything if a loan goes bad. And collateral is also the incentive of the borrower to be careful with the use of the money they borrow, because they have put up collateral. The classic example is a mortgage on a house. If you borrow money to buy a house, you have the house as your collateral. If you fail to make the payments on the house, the bank may end up repossessing your house. Now, the bank doesn't want your house, the bank wants your money, but if you lose all your money, at least the bank has the sort of insurance policy, the backup policy, that it gets something in exchange to help it recover from its loss. And one last thing about regular borrowers and lenders to a bank: the word mortgage. This is the literacy minute here. The word mortgage, which is actually spelled M-O-R-T-G-A-G-E, comes from Old French, and the M-O-R-T, mort, means dead, and gage, G-A-G-E, means pledge. So a mortgage is a dead pledge. Okay, you fail, your promise to repay is dead. You have got to turn over the thing you pledged, like your house. All right, moving on to the bond market. Now, up till now, we've been using the example of the local bank or credit union. So it's individual households that are doing the borrowing or lending. If they're lending money and depositing money to the bank, they're basically lending to the bank in a way. But what if you're not an individual? You're not an individual household. You're actually a corporation. You're a company, and you need to borrow. Well, if your company is big enough, you can bypass the local bank and credit union. You don't need them. You're able to do your own financial arrangements. And that means that you can go to what's called the bond market. Now, the bond market is completely different from the banking sector. The bond market is a market of basically trade through individuals issuing promissory notes, a bond, and placing those promissory notes in a market called a bond market. And anybody who wants to lend to you buys a bond. They buy your bond. And by buying your bond, they're lending to you. So this system of bond markets is a sort of market mechanism that bypasses the bank route. The bank is a different way of borrowing and lending. The bond market is using a market and a tradable instrument called a bond. So you're a corporation and you're an investor too, maybe. The corporation is the entity that's trying to borrow. The investor, an investor here can mean an organization, let's be clear. An investor, we're not necessarily talking about individuals here, although we could be. Investors are entities that enter the bond market. So the seller of a bond, or also called a corporate IOU, puts this bond out in a market where there's trading going on and hopes that there's a buyer for the bond. And the bond, imagine the bond is a piece of paper, and that piece of paper puts down in legally enforceable terms how much is the principal, how much money is due, how much money is being borrowed, and how much money has to be returned at maturity date, plus regular interest payments until the maturity date, and then that all accrues to whoever is holding the bond at the time a payment is due. So this is a way to borrow from some anonymous lender, and a lender you're not working through a bank, and you're not working one-on-one. You're sort of using the financial instrument called the bond to perform the function of allowing you to borrow. But the bond has to specify very clearly what the repayment terms are. The bond is sort of itself a contract. Bonds could be paid back over a long period of time, and the bond will set out a payment schedule, including a maturity payment date at the end. So bonds can be 3 months, 1 year, 2 years, 5 years, 10 years, 20 years. There once was even an infinite bond, a bond that paid out money forever, that the British government issued 200 years ago. And bonds come with a risk. If you buy a bond, you are lending to the corporation that issued the bond. And so if you buy a bond, you still have risk. And in this case, it's called default risk, or the risk that the borrower will not pay back the loan. And in the bond market, everything else equal, if a borrower, the issuer of the bond, is perceived as being high risk, they will have to offer a better return in order to induce buyers to buy their bonds. And the interest rates that are offered on a bond differ depending on who the borrower is, and the repayment schedule, the amount of the loan, the type of collateral, and many other features. So there's an enormous variety in bonds of different types. By the way, this is why the US government bond, a treasury bond, that is, US treasury bond, typically only has to offer a relatively low amount of interest, because it is viewed as a very safe bond, a bond with basically zero risk of default. If you are a corporation in the high-tech sector in Silicon Valley, and your business is creating new technology, you are a much more high-risk borrower than the US government is. So everything else equal, you will have to offer some combination of a better payout and better collateral. If you want people to buy your bonds, you've got to make it attractive. So let's use our interest rate and savings borrowing demand and supply model to figure out what happens if we've got in the market a balance between supply of savings and private demand. And that is to say, the borrowers are the private demand, and let's suppose the borrowers are all private business, the private sector. Okay, so the private sector represents private demand to borrow, and the supply of savings comes from individuals and anywhere else where there's savings. And let's suppose now the US government suddenly decides it wants to borrow a lot of money. Okay, the US government wants to enter into this bond market, and it will do that by having an intern in the Treasury Department go to the basement and get out the photocopier and print a bunch of US bonds, brand new US bonds. And those bonds are promises to pay the holder of that bond dollars on an agreed upon schedule. And so what happens now is the US government enters this bond market, and it adds demand for loans. It adds to the demand for loanable funds. So you see there's a private demand curve for loanable funds. That's the private corporations, private individuals, demand to borrow, and what they're borrowing are these loanable funds. And now the US government enters the picture. And what the US government does is it adds to the demand. And so what you see is a movement out to the right there. And so now the relevant demand line is B, the red one. And so if you've increased demand, then what's going to happen is that interest rates will go up. And if interest rates go up, and also quantity savings borrowings go up, what's happened is you've caused interest rates to go up. So what's happening here is, in effect, that the US government is entering the market and competing for loanable funds. The US government now is competing with the private sector for those finite, well, not finite, but sort of, limited supply loanable funds. And if you've got an increase in demand, of course, the market price, the interest rate will go up. So we have a term for this. It's called crowding out. The federal government enters the market for limited loanable funds and competes for those funds, and competes by offering a higher interest rate, and that crowds out some of the private sector from having access to those loanable funds. Crowding out is when private sector investment is reduced because of competition from government borrowing. So what kind of bonds does the US government issue? Well, the US government issues what are called T-bonds or T-bills or zero coupon bonds. There are three types, and the T-bonds are the longest term. They're 30-year bonds, and they pay interest every 6 months. T-notes have a shorter maturity. They're from 2 to 10 years in maturity, and they pay interest every 6 months. T-bills are much more short-term. They range from a few days to 26 weeks, and they only pay at maturity. So there's no regular payment with a T-bill. There's only one big payment at the end when the T-bill comes due. And zero coupon bonds or discount bonds also pay only at maturity. So here's the basic mechanics of how a bond works. So a bond is a promise to pay, and bonds are bought and sold on bond markets. If you buy a bond, you are going to get an implicit rate of return, and the implicit rate of return is basically a calculation that factors in all the payments you'll get and that adjusts that for how many years the bond will be before it matures. So the rate of return is equal to the face value, what's sort of the official payment to you from the bond is determined what is metaphorically written on the bond, or the face value. But then what you do is you subtract off the price you pay, because of course you expect to make a profit on buying this bond. So there's a face value, that's the promise to pay, adjusted for time and discounted back and all of that. And I won't get into how you discount back, just to say that you account for the fact that some payments are going to occur in the future. And you subtract from that face value the price you pay for the bond, divide by the price you pay for the bond times 100, and that gives you a measure of what you expect to be your rate of return. So for example, suppose you bought a 1-year bond, so it's going to pay after 1 year. It has a face value of $1,000. So that means at the end of 1 year, you're going to receive $1,000. And suppose you paid $909 in the market to buy that bond. So what that means is you're going to have 1,000 minus 909 divided by 909 times 100 as your rate of return. And if you do the math, it works out to be a 10% return. Now, let's be clear. When you buy a bond, the face value written on the bond is there to tell you what the repayments will be. The face value on the bond is not a statement at all about what this bond will actually trade at in the markets. And in fact, the face value has to be more than what you're going to pay to get the bond. Otherwise, you'd make no profit. Okay, so what's written on the bond is basically telling you the terms at which the payments will be made. And sort of to repeat, it doesn't matter if you're the first person who bought the bond when it was first issued, or you're somebody who bought it later. These bonds can be traded and retraded. They're instruments. They can be bought and sold 1,000 times over. It's the payments on the bond go to whoever is the holder at the time the payment becomes due. That's why this instrument can be easily traded. Unlike a house, you don't have to have property ownership documents exchanged or anything like that. I hand you the bond, you hand me the money, you are now the owner of the bond, you're the one who's going to collect any payments from the bond plus a maturity payment at the end. A fundamental principle in finance is arbitrage, and arbitrage says because financial instruments are so easily traded, and remember, these instruments are not on paper literally anymore. When I use the word something is written on paper on the bond, I don't actually literally mean there's a piece of paper with a bond information stamped on it. Bonds now are all electronic. All of these things are electronic. No one is using paper to do these deals. But when we use terms like the face value, we're using an old-fashioned term back from the days when these things really were stuff you could hold. Okay, now arbitrage just means that financial markets are so efficient, they're so fast, and it's so easy to transact. You can even don't need live humans to do it, that two financial instruments that have the same terms, including the same risk level, will trade at the same price in the markets. And the reason they'll trade at the same price in the markets is because if they were not trading at the same price in markets, you could make a zero risk profit simply by taking the instrument that was overpriced, selling it, and then buying the exact equivalent sort of deal, but at a lower price. So arbitrage is so efficient, since it's all kind of done by computers now, that you're going to have a consistency across the financial markets when you factor in risk, return, and all of that stuff. So bond prices and interest rates have to kind of be consistent. And this is the statement of what arbitrage is: the buying and selling of equally risky assets. Arbitrage ensures that equally risky assets earn equal returns. So we've talked about borrowing and lending from a bank, and we've talked about borrowing through the bond market. Now, another kind of market we use is the stock market. In the case of the stock market, what's happening is that our businesses need to raise money, and they can borrow from a bank if they want, and they can issue bonds if they want. But a third way that businesses raise money is by selling shares of ownership in the company. So businesses, although they can sell shares directly, mostly they find that is inefficient. That's not what their business is. They're not in the business of stock trading. So businesses will create ownership shares and put those shares on the market for people to trade. And this is a way for businesses to raise money. They're basically saying to potential investors, hey, if you want, you can buy a share of our company. If we make profit, you make profit. If we make a loss, you make a loss. And the money you pay for your ownership share, we will use to buy capital and invest in the business. So the stock market is a way for a profitable venture to raise the cash that it needs to grow. So far, we've given a kind of idealistic story about how financial markets work. And we're talking about how they work to raise capital, to raise funds for individuals or businesses who need money. Now we need to get into the question of, if all of this system works perfectly, no problem, but what if something fails? What if intermediation fails? And the analogy here is to take the bridge, but now instead of a perfectly functioning bridge, we have a bridge that is damaged. And the bridge can be damaged by different things. And the kind of things that can damage this intermediation bridge include things like insecure property rights, politicized lending, government banks, interest rate controls, inflation, and bank failures and panics. And so there's multiple ways that this very elaborate, though vital system can get in trouble. One problem is insecure property rights. So if you have a government that does not honor property rights, that's a problem. It's going to inhibit investment. And especially in times of emergencies, governments may confiscate savings. They may freeze bank accounts or other restrictions, and there's countless examples. So for example, when Argentina froze bank accounts in 2001, many banks failed, and the Argentinians who had their savings at those banks lost everything. So insecure property rights are one way that a financial system may be questionable or fail. If you're not confident that the banking system, or the financial system, is secure according to the law, that's a problem. Now we're going to get a little bit into the topic of leverage. Leverage is kind of important because leverage is a thing where if it is excessive, it adds risk to the financial sector. And leverage is basically a number measuring the degree to which a borrower has taken risk. That's the essence of it. It's a measure of how much risk a borrower has taken on when they've engaged in some kind of contract. And let's talk in terms of houses, because when we talk about leverage in terms of borrowing to buy a house, it's much more intuitive than if we use the example of borrowing connected to a business finance or even government finance. So imagine a situation with a house, and there are certain terms involved. One is owner equity. Owner equity means the share of the house that the owner of the house actually kind of effectively really owns. And what you really own, or your owner equity, is the value of the asset minus the debt. So if you buy a house for $300,000 and you've actually paid only $200,000 of the $300,000, that means there's $100,000 that is your debt. And the leverage ratio is a quick way to measure how serious is your debt as a share of your ownership. So whether you don't look at the problem of debt from an absolute number, you look at it from how much of the share of the value of the house is still owing, is still debt, and how much of the house do you actually own outright. So let's go through an example. And this house example is not just intuitive, but it also pertains to the financial crisis of 2007 to 2008, because the financial crisis of 2007 to 2008, or 2007, 2009, it arose from the housing sector. So this example is not just an exercise in arithmetic, it actually relates to the real event that happened. So imagine there's a house and the market value of the house is $400,000. And let's suppose you borrow money to buy that house. And so let's suppose you are able to use 20% of the price of the house. You're able to pay that with your own money, your own cash. You have enough cash to pay 1/5 of $400,000. Okay, so 1/5 of $400,000 is $80,000. So you've paid $80,000. You own $80,000 of that house outright, but you still owe $320,000 to pay off the house. Okay, you had to borrow. You had to get a mortgage for $320,000 before you could buy the house. So equity, the share you own, is $400,000 minus $320,000, which equals $80,000. So what's the leverage ratio? Well, we put your payment in the denominator. So you have $80,000 in the denominator, and the amount you still owe is in the numerator. And 320,000 divided by 80,000 is equal to exactly 4. So in this example, your leverage ratio is 4. Now, what happens to the leverage ratio if you take on a more risky arrangement? In this more risky arrangement, you only put down 10%, not 20%, 10%. You only have 10%, so you're putting down $40,000 to buy the house. So your remaining debt is $360,000. So your leverage ratio is $360,000. That's what is still owing the bank and to pay your mortgage, divided by the $40,000 of the house that you've actually paid for, that you actually own in your own right. So 360,000 divided by 40,000 is equal to 9. So when you went from a leverage ratio of 4 to 9, we say that your risk level has gone up, your leverage ratio has gone up. Here's an image showing you why the term leverage is used. It's an analogy. It's an analogy in physics to the idea of leverage. So the little dollar coins you see down there are what the buyer for the house is actually putting down, and then the light bulb thing that's being lifted is the house. And the idea is, if you sort of change the setup of that leverage device so that the right hand side bar is longer than the left hand side bar, you can put a weight on the right hand side that can manage to lift that light bulb thing some distance. And the idea being that you don't need 100% payment in order to buy a house. You can borrow to cover the remaining amount. So let's get into the topic of the financial crisis. And here's part of why it was a problem. It's a very complicated story, and so we cannot cover everything, but in the context of what we're doing is the following. The traditional mortgage story is very simple. You have a system that's quite robust, and the reason it's robust is that if a bunch of homeowners borrowed more money to buy a house than they could afford to pay, then those individual homeowners would lose their house, and that would limit the damage to the people who made risky choices to borrow. But the reason the financial crisis became much broader and more serious than affecting a handful of homeowners is that the mortgage loans did not remain simply on the books of banks or mortgage companies. What happened is those bad loans were securitized. That is to say, they were bundled together and sold as a desirable financial asset. They were called mortgage-backed securities. And those mortgage-backed securities were sold onward and further onward until the mortgage-backed securities, which were fundamentally very risky, were distributed widely throughout the world. And central banks owned them, corporations owned them, regular banks owned them, governments owned them. So what happened is the risk, which should have been concentrated on the people who could not afford to pay back their loans, actually got distributed throughout the entire world. And it got distributed in a way that was opaque. It wasn't clear where the risk lay. See, that's the other advantage of a simple mortgage loan. You know who is bearing the risk. You know exactly who will pay the price if the loan goes bad. But these mortgage-backed securities sort of mixed good securities with bad securities and then distributed those, and those securities were treated as if they had little risk, even though there was serious risk buried inside those mortgage-backed securities. The mortgage-backed securities were being incorrectly rated as AAA or AA. So they were bought and stored in places where they should not be. Now, a little more about how the mortgage-backed securities were supposed to work. What the idea was that as income came in from people paying their mortgages, that income would be channeled out to pay the owners of the mortgage-backed securities, the mortgage-backed assets. But if there's bad loans, that stream of future payments stops and those mortgage-backed securities become worthless. And so a lot of entities and people and places were holding bad debt, but they weren't holding bad debt knowing that it was bad debt, or they were reckless, they were indifferent, or they were careless. They were holding debt for purposes that they should not have been holding bad debt. So what triggered the collapse? Everything was going fine. What triggered the collapse was that housing prices fell for various reasons we don't have to go into, but there was a normal market cycle in the housing market, especially in the United States. And as housing prices started to fall, people who had borrowed a lot to pay for those houses, to pay, to own a house, realized that they owed more on the house than the house was now worth. So rationally speaking, they decided to default on their loans. They figured, why should I pay $600,000 in debt for a house that's only worth $300,000 now? It makes no sense. I'll just default. I'll take my loss rather than hold a bigger loss by keeping ownership of a house whose a mortgage I can't afford to pay. And the other thing was, as house prices fell, interest rates went up. So it wasn't just that the value of the house was less, it was that the payments demanded on the house were more. So delinquency and foreclosure rates more than doubled. Many owners owed more on their mortgage than what their house was worth. And so people defaulted, and many banks and financial intermediaries ended up with loans and assets of questionable value. There's another angle to the story. The other angle is that when we talk about banks, we normally think of our local bank. Now, our local bank is very safe. And the local bank is safe because it is guaranteed by the federal government, basically the Federal Deposit Insurance Corporation. And this kind of insurance and protection comes out of decades ago when local banks would fail. And so your local bank or local credit union is guaranteed. And it's guaranteed in the sense that even if the bank should fail, which would be very, very rare, this Federal Deposit Insurance Corporation will step in and give everybody their money back. However, the mortgage-backed securities were not held by your regular what are called depository institutions. They had no backing. They had no real insurance. And so you had this so-called shadow banking system that included investment banks, hedge funds, money market funds, and all other kinds. And they had really no sort of insurance or guarantee behind them. So when all those mortgages went bad and values of house went bad and interest rates go up, there were a lot of institutions that effectively became bankrupt, and the number of bankrupt institutions were widely spread even around the world. So that triggered a sort of financial collapse. A natural question would be, where was the financial regulation for these shadow banks? Well, they were basically not regulated hardly at all. So the regulators and policymakers were not regulating this shadow banking system. The regulators and policymakers were unaware of how big and how important it was, and they were unaware of what was going on inside these institutions. And here's the problem. If you're not regulating these institutions, then those institutions are not required to tell you what's going on. So you had a twin problem, that the regulators were not empowered to manage the shadow banking system. They also didn't know what was going on within the shadow banking system. It is basically financial regulation that not only empowers authorities to regulate a banking system, it's also regulation which generates the data, the information that the regulators need to know what is going on. So at its peak in 2008, the shadow banking system lent $20 trillion around the world, and that considerably exceeded what the traditional banking system was doing. So this sort of invisible shadow banking system actually now was bigger and more of a threat to the security and sort of reliability of the world banking system than the traditional banking system had ever been. So house prices fell and there was a kind of domino effect. So the highly leveraged shadow banks were pushed toward insolvency. By the way, when we say a shadow bank, we don't actually mean the institution has the word bank in its name. It could be like a mortgage company. It could be a finance company. So for example, automobile companies create their own financial entities to create loans for car buyers. So if you are offered a deal by a car dealer who says, hey, I can get you a lower interest rate if you buy this car, it does not mean that they are going to your local bank and negotiating a lower rate for you. It means that the car manufacturer has their own sort of financial company attached to them, and that company is making loans to car buyers. And this is legal as long as these shadow banks or these other kind of financial entities are not taking deposits. That's the line where regulation kicks in. If you have something called a bank, or something called by something similar to calling itself a bank, and it takes deposits, it immediately gets regulated heavily. But if it is not taking deposits, it's kind of fairly free to do whatever it wants. Okay, so to the end of the story. It wasn't clear who owned what, who faced the worst losses. It's a very complicated, messy story. So the risk level on loans went up, even on loans that were actually good, but nobody knew what was a good loan, what was a bad loan, what was a risky lender, what was a non-risky lender or borrower. And so ultimately, credit markets froze up. That is, no one wants to take the risk of making a loan to somebody who might default. And their problem is they don't know who might default. So all of this is happening internally to the financial system. This is sort of kind of opaque to the regular person. We only interact with our local bank. We as individuals, regular individuals, do not interact directly with the shadow banking system except through a kind of intermediary like the car dealership, for example. But we don't deal with the shadow banking system directly at all, so it's kind of invisible to us. So anyway, credit markets froze up. That means nobody was willing to make loans to anybody else. And when I say loans here in credit markets, I mean loans from one institution to another institution. I'm not talking about your local bank or credit union. I'm talking about institutions in the financial shadow banking system and the regular banking system making loans to each other. And that's another factor here that is outside the regular experience of regular people. Financial institutions, financial companies, financial corporations, the entities that work within this financial system broadly defined are always lending to each other. They're borrowing and lending every day. Billions and billions, even trillions of loans occur within the finance system itself. This is another bias we have because we only interact with the financial sector in the sense that we want to borrow to buy a car, to renovate a house, to buy a house, maybe to set up a business. So our intuition is that finance is always directly connected to something real. And actually within the financial sector, there's a lot of intra-financial sector borrowing and lending and exchange. And so when we say credit markets froze up, that's the sort of primary freezing up we're talking about. Now, of course, that filters down to the regular banking system, and the regular banking system and regular people are kind of affected. For one thing, interest rates go up. That directly affects everybody. So all of this bad stuff, kind of came that way. Now, all of this was happening over a period of 2, 3, 4 years. So in these few slides, we are condensing a story that took 3 years to work itself out into a few slides. So we're just hitting the highlights here. So as a result of the financial crisis, there have been changes made, and the scope of the regulators has been expanded. New financial regulations are bringing the shadow banking system out of the shadows, and banks are required to hold more equity. That is to say, they're supposed to reduce the amount of their leverage. So it has changed, although we still don't know perfectly whether the problem has been fixed for the future. So looking back at the big picture on the takeaways. One is that saving and borrowing allows individuals, firms, and governments to smooth consumption over time. So that's one reason for borrowing and lending. And we have a very broad, extensive system of financial intermediaries who bridge the gap between savers and borrowers. That's sort of the ultimate ground level of what finance is supposed to be doing. But financial intermediaries also collect savings and evaluate investments, diversify risk, help finance new and innovative ideas. And because the range of finance is so broad, we have many different sorts of institutions, and the different sorts of institutions are tailored to the kind of risk they're dealing with. One example I didn't talk about was venture capitalists. Venture capitalists are private entities where rich investors pool their money, and the venture capitalists fund risky projects, usually in technology. Now that requires very different evaluation criteria compared to somebody who wants to borrow money to buy a house. And institutions that are lending to finance big capital projects like building a bridge or building a skyscraper, that's a different kind of funding, and the risk work differently. So we have a kind of ecology, a whole kind of zoo of different sorts of financial institution for different purposes. And the role of regulators here is to be fully informed about not just what's happening, but what the potential risks are, and also how resilient the financial sector is. If interest rates are low and the economy is booming, everything can seem okay. But the job of regulators is to imagine, well, what would happen if there's some kind of big negative shock to the economy? Maybe coming from the real world, like a pandemic. I mean, how robust is this system? It's like saying you don't measure the seaworthiness of a ship by looking at it only when the weather is good. You've got to at least be able to imagine what would happen if the weather is bad. And so that's a sort of future important job and sort of responsibility of the regulators. And they've been given broader powers now. Before, they were not allowed to investigate the sort of shadow banking system. They were told to keep out, and that's changed. So there's a lot of complexity in the financial system, and trade over time is a fundamental thing. Borrowing and lending is a fundamental thing, and you have to have that enabled in an economy if you want investment, if you want consumption smoothing. You have to have a financial sector, but a financial sector can come under stress if you have things like insecure property rights, inflation, politicized lending, bank failures, panics. There's all kinds of things that can bring a system down. The 2007 to 2008 crisis was brought about by having a system that was vulnerable to a downturn in the housing market. That's the one sentence description of the problem. The entire sort of system was built on the assumption that house prices would keep rising forever, but they did not. They started to fall because there was a housing price bubble, which is another kind of phenomenon I haven't talked about. Okay, but these things happen. There was a housing price bubble, and when house prices started to fall, it set off a kind of domino effect, and the financial system was not constructed to be resilient to that kind of shock, and there were all kinds of hidden risks, and that had all the negative effects. So hopefully, though, there's some lessons learned, and that finishes us for our chapter here.